Welcome to another episode of Equity Mates. My name is Bryce, and as always, I'm joined by my equity buddy Ren. How are you going?
I'm very good, Bryce. Great to be back here. End of the week, well, end of our week at least.
Yes.
We've had a great week. I've got on my high horse a little bit, giving
You
a few
have.
rants. You've told
Apologies.
us that you are invested in Trump's stock.
No.
Fascinating week here. But look, we're closing out the week. We're joined by an expert, and we really want to dig in on, I guess, their philosophy, and in particular, how he runs a high conviction portfolio.
That's it. It is our absolute pleasure to welcome to Equity Mates on AusBiz, Bob Desmond. Bob, welcome.
Hi guys, how you going?
Very well, thank you. We're really looking forward to today. As Ren said, we're going to be discussing and unpacking your process for leading the team and the funds over at Claremont. But for those who haven't come across you before, Bob is a portfolio manager and head of Claremont Global. The team run a focused, low turnover portfolio of 10 to 15 businesses and have assets under management of over $1 billion. So, Bob, I guess let's start with that. You know, we talk about diversifying and, you know, setting up a portfolio and portfolio construction. Why is your approach just to have sort of 10 to 15 stocks? What's the theory behind that?
I guess the theory for us, where I would come from, is we try and think about businesses rather than stocks. And if you think of when you apply our investment criteria, we find there's very few businesses globally that would probably make the screen. So, you know, those criteria are consistently high returns on capital, usual stuff you've heard before, good balance sheets, good capital allocation, structural growth, fairly easy businesses to understand. We don't like complicated businesses. First of all, I think there's just very few businesses, large parts of the market that don't really fulfill those criteria. So financials, resources, biotech, pharmaceuticals, anything we think of as complicated, regulated, leveraged, commoditized, we're just not really interested in. So you narrow the market down really quickly. And then, you know, there's markets generally efficient. So there's very few of those that are available at the price that allows you to make a decent return. So when you put those two things together, and then you've got to try and find a management team you're comfortable with as well, and do they allocate capital well? And you know, there just are very few, I think, really good opportunities. So we want to concentrate our capital on our best ideas. And again, thinking like a business person, if you think of businesses, we all think our businesses, everyone says, oh, they should concentrate their capital on their core divisions. But then somehow when it comes to investment, we say, oh no, you should diversify your capital amongst your worst ideas. I've never really understood that.
So, you know, the big question, Bob, that we often struggle with is how you actually go about finding these companies. You know, the investable universe is so big and there's so many, I guess, potential opportunities out there. As you mentioned, you can strike a number of industries from the investable universe straight away. But then when you get to those industries where there is potential, how do you go about finding those needles in that haystack? Is it qualitative? Is it screeners and more quantitative based? What's you and the team's process?
Yeah, I mean, first thing I'd say is that they're not, our portfolio, they're not needles in a haystack. They're pretty well-known businesses. So across the portfolio, I think the youngest heritage is Alphabet, which was, you know, founded in 1999. And the oldest business we have is 166 years old, dates back to the US Civil War. And the average age of the businesses in the portfolio is over 80 years old. So they're pretty well-known businesses. They're pretty durable. They've seen a lot of cycles. But, you know, in terms of narrowing it down, if you take the 70,000 global businesses, we screen at 3 billion market cap. You know, that would get us probably to 11,000 stocks. We screen out poor balance sheets. We screen out low return on capital. We screen out all those industries I spoke about earlier. We screen out companies that have a whole heap of excess growth, not subpar growth, excess growth. And that's companies that have got heaps of goodwill on their balance sheets, who grow by issuing shares every single year and like making acquisitions. And normally you kind of see a pattern. It's, you know, good EPS growth, but return on capital falls every year. More shares get issued. Goodwill balloons every year. Screen those out. And that kind of gets us to a working list, once I've screened out all the sort of industries we don't want to be in, of about 250 stocks. And then from that, we draw up a working list, what we call our watch list, of about 100. And then from that, we have what we call an approved list, which has done all our due diligence. It's just a question of the company being at the right price for portfolio inclusion, of about 40 names. And from that, we construct a portfolio of 10 to 15 businesses.
So Bob, in that 10 to 15, how do you think about weighting in the portfolio? You know, if you have to have such a high level of conviction when you're only investing in 10 to 15 names, do you then take an equal weight approach? Or within that portfolio, do you have more conviction on some and you give them more weighting in the portfolio?
Yeah, good question. I think on that generally, so for every business we own, we will have an estimate of fair value, and so obviously those businesses that trade at a larger discount to that value, they will get more capital, generally speaking. But there will be an overlay on that in terms of, you know, how long have we followed the business, how well do we know it, is there anything there which might lessen our conviction slightly or increase our conviction. So generally, when a business comes into the portfolio, we won't go to a full weight, especially if there is something that needs proving out, because often you don't get an attractive entry point unless there's some sort of short-term concern. There are times, you know, last year being March last year, when everything was on sale, when it's, you know, we went very quickly to a 9% position on Microsoft because we'd followed it for 4 years. It was a terrific business, and we thought this is going to be a once-in-a-lifetime opportunity. Let's back up the truck. But more often than not, it'll be start and add to the position as conviction grows.
So, Bob, we've been doing a lot of content in Equity Mates at the moment around building an investment thesis and using that as a way to decide when to actually get out of positions if your thesis is broken. With such high conviction, 10 to 15 stocks, but so many, I would imagine, sort of exciting opportunities sitting on the sidelines, is price the only factor, or valuation the only factor to decide what switches in and out? Or how often are you reviewing your thesis for Alphabet, for example, or Microsoft,
Sure.
like businesses that seem like they're going to be performing for the next decade or so?
So firstly, I'd say that alternative, you know, like when you say there's lots of things, exciting opportunities on the sidelines, for us, we find they're very few that kind of tick the quality, that tick the people, that tick the valuation criteria. So good ideas for us are quite rare. And so most of the time we're just doing maintenance work, understanding the companies better, talking to the competitors, talking to industry people, just kind of building a collective database on that business. So when you get the inevitable blip, I mean, to give you an example, something like Nike, we'd pretty much followed for a decade, and we only got our first opportunity earlier this year. But in that meantime, you just kind of constantly building up your database. But then something like, you know, to answer Alphabet, we review the results every quarter. Unfortunately, with Alphabet, it's quite hard to get to speak to the company. But for most of our companies, we review the results. We'll talk to the company. We'll talk to the competitors. And when we find the thesis has changed and we get a surprise, more often than not, we'll just cut the position straight away. And the golden rule we always use is if a price has gone against you and you're not willing to add to that position, you should be selling it, because you obviously haven't got conviction. So more often than not with our businesses, when the price is falling, we want to be adding to it, because your entry points are very limited. The market is generally efficient, and when the opportunity comes, you must move quickly. And if you're kind of not sure whether to, probably telling you don't have conviction.
I love that golden rule, Bob. I think that's a great, thing to keep in mind, especially, you know, for people, Bryson, my age, who perhaps haven't seen too many, you know, long-term bear markets. That'll be a good rule of thumb to have at that time. I'd love to get specific and hear about some of the stocks in your portfolio that you have such high conviction on. We've touched on a couple today in Alphabet and Microsoft, and really there's no surprise when it comes to why those stocks you have such high conviction on. So many people can see what fantastic businesses they are. In your portfolio, are there any other companies that you'd be happy to tell us about? Maybe some that would be a little bit more surprising than the Alphabets and Microsofts of the world?
Sure. Just looking at the list here, I'll try and find one that's probably less obvious. Something like Aon that we own in the portfolio. That's not a really. I mean, people know it as 60% of their business is insurance broking, but then they also have other businesses in health, talent, investments, data and analytics. But we really like this type of business. It's right in our sweet spot. You think of risk and insurance. Regardless of what's happening, you're going to have to insure lots of things. Your properties, your workforce, workers' compensation, directors and officers, cyber. I mean, we're not talking home and contents insurance here. So, we're talking large companies with complicated risks. And consistently, this business over time, it doesn't sound that exciting. It's grown its top line, call it 4 or 5% organic. But they're very big margins. They run at 28% EBIT margins. They're very capital light. They have hardly any working capital, and probably in the next few years will move to neutral working capital. And capex is just over 1% of sales. So they print huge amounts of cash, and they buy back a lot of stock. And once you put all those, every year their revenues grow slightly faster than their expenses, and they control that very tightly. So they get probably on average 70 basis points of margin a year. And you put that earnings algorithm together, and over long periods of time, it's grown at low double digit. And so, a lot of people say, oh, that's not very exciting, insurance broking. Oh, I'd much prefer into some, but a lot of the return we think about is not just the growth, it's the predictability of that growth and the probability that we could be wrong. So I think where a lot of investors, well, in my opinion, make potential mistakes is they consistently look at the size of the opportunity or the upside, but they forget to handicap the probability or the risk. So, there's lots of industries that are very fast growing and very exciting, but normally that comes with a whole heap of risk and opportunity. You look at something like insurance, it's just a very consolidated oligopoly, and it's dominated by a few large players. And if I'm a company, I'm going to be going to them for my needs. And it grows with GDP. And so that's something that we have in the portfolio. We've owned it for a number of years, and hopefully we'll own it for a number of years in the future.
Always great to hear stocks from the mouths of the experts, and I'm sure plenty of the Equity Mates community will put that one on their watch list. But Bob, unfortunately, that is all we have time for today. A massive thank you for sharing your time with us. If any of the community would like to follow what you're doing at Claremont, what would be the best place to do so?
I'll go to our website. So it's claremontglobal.com.au. You can find us obviously on LinkedIn as well. And if you do go to our website, I'd encourage any viewers to look at our owner's manual there. It's in the section there, I think in the report section, and it highlights our investment philosophy and also highlights the way we like to partner with clients. And I think it's a really good roadmap of how we run the business at Claremont.
We'll make sure that we'll include that in our show notes on YouTube. But as I said, Bob, thank you very much, and look forward to keeping in touch.
Thanks, guys, and thank you for your time.
And that does bring us to the end of our episode today and the end of another week here at AusBiz. Massive week. Hopefully we're back next week and Ren hasn't been cancelled from his Nationals outburst. But we'll see. I'm sure we will be. Ren, as always, it's been great, and we'll pick it up on Monday.
Look, I might take next week off. So Bryce will see you next week. I'll see you the week after.
See you then.